Sole proprietors are the easiest form of business to operate. Your tax return is filed on your personal return 1040 on a Schedule C. The income on from the business is input on the Schedule C, and then the expenses are put on the Schedule C, and then the net between those two, the income less the expenses, will flow from the Schedule C onto your Schedule SC, which is where the self-employment tax is calculated. Now, the self-employment tax on a sole proprietorship is generally 15%. Now 15%, that's 15% on top of whatever your regular income tax is. So if you have a $50,000 net income on your business, your Schedule C, that's going to flow to Schedule SC, and then calculate the tax. That's going to be $7,500. Then your $50,000 net income is going to go to the first page of your 1040. You get to net out your standard deduction. Say you're married, filing jointly, is a $24,000 standard deduction for now. Then that puts you in a 12% tax bracket. So 12% of your net income, taxable income, is $3,120. So your tax bill is going to be the $7,500 self-employment tax plus the $3,120 of net or of income tax. So the total tax bill is going to be $10,620. If you're filing a corporation, filing as a corporation, the corporation is going to file an income tax itself, and if it's a C corporation, the taxes will be paid by the corporation. It's totally separate from the individuals and from the owners. Currently, the tax rate for C corporations is 21%. If the only way that the individual is taxed on any of the income from the corporation is if the corporation pays the individual owner, a C corporation, pays the individual owner a dividend or pays them as an employee. Otherwise, the income is, and the tax and everything's paid from the corporation. If you file as a S corporation, and the S corporation is different than the C corporation because the S corporation doesn't pay the income tax itself. The S corporation files a tax return, 1120S, and the income from that flows through to the individual owners. The individual owners get a K1, and on the K1 it'll tell them what their share of the income is that they have to report on their tax return, and then the taxes are paid on the individual tax return. So the big difference to think about for sole proprietor versus a corporation is the self-employment tax. So the self-employment tax, the individual has to pay that. If you're filing as a corporation, the self-employment tax doesn't come into play. Now, one thing to keep in mind is that for S corporations, the IRS says that owners should pay themselves a reasonable salary so that they're paying something into self-employment tax. They leave it up to the interpretation, sort of up to judgment. One thing, guidance is how much would you pay somebody to do the same job that you're doing, and that's one rule of thumb that the IRS uses. Another thing to keep in mind is what is your net income, because if you're running an S corporation, say it's the first year and you're barely making any money, or you're just breaking even without paying yourself a salary, then the IRS is not going to expect you to pay the salary and cause the net income to be negative. So if you're just breaking even, they're not, or not making much of an income, the IRS is not going to expect you to pay a salary.